Stock Investing 101, going back to the basics. Here is everything you need to know about stock investing. This video is a great resource for absolute beginners and a valuable refresher for retail investors who don't follow market news on a regular basis. A lot of stuff happens in the world's economy every day that you can trace back to stocks, bonds, mutual funds, and other types of financial instruments that structurally define or affect prices of everything from the food you eat to the gas powering your car. Watch now. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing terrific. If you are, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about stock investing 101. Let's go back to the fundamentals here. What is a stock? A stock represents a stake in a company. So when you buy Facebook, when you buy a share of Facebook, a share of Amazon, a share of any company that is publicly traded, you have a stake in a company. You can even buy a stock in a private company. The rules are the same. They're just different when it comes to the kind of visibility, the kind of exposure, the kind of regulatory compliance you have to have. When you own a share of stock, you are a part owner in the company with a claim, however small it may be, on every asset and every penny in earnings. Now, unless you own a significant chunk of a company's stock, it's not as if you have a real estate how things are done. You have small investors, small shareholders, and the big shareholders. If you own, for instance, let's just say you own 100 shares of Amazon, that makes you technically Jeff Bezos' boss, but that does not mean you can call him up and give him a tongue lashing. However, it's that ownership structure that gives a stock its value. If stockholders didn't have a claim on earnings, then stock certificates ultimately will be worth no more than the paper they were printed on. How do you make money on stock? There are two possible ways to make money on stocks. First, you have a gain, so the stock price goes up. So if you buy a share of Tesla, for instance, at 1,000 and the share goes to 2,000, then you have a gain of 1,000. Now that gain is unrealized because you haven't sold the stock yet. So as long as you hold on to the share, that gain, that profit, is what accountants call unrealized gain. That's the first part. The second way to make money on stocks is through dividends. So every 3 months or 6 months or year, companies, if the board of directors so decides, will distribute dividends. Let's talk really about what dividends are. What are they? What is a dividend? A dividend is a payout that some companies make to shareholders that reflects the company's earnings. And this is often paid out, as I said a few minutes ago. It's paid out every 3 months, every quarter, every 6 months, every year, depending upon the cash position of the company, the board of directors' decisions, and management's operational values, operational approach. If management wants to increase their capital investments, they will take the money and reinvest it in the company rather than paying investors dividends. Typically, older, well-established companies pay dividends, while newer companies do not. And that makes sense. Newer companies would rather use the money to reinvest into the operations of the business so they can grow faster. Dividends are not guaranteed, so a company can stop paying them at any time. They're not required by law. So to keep your money growing as fast as possible, it is smart to invest your dividends to keep reinvesting them rather than spending them when you receive them. And you can do this, and the easiest way is to sign up for something called a DRIP. A DRIP is a dividend reinvestment plan, a DRIP, and that will automate the reinvestment process. And this is kind of important for several reasons, but I just want to focus on two here. The first is that you are saving money on taxes, because if you receive a dividend and you spend it, you have to declare that income to the IRS at the end of the year through your 1099.div, and you have to pay taxes on those dividends. And the second thing is that by reinvesting the dividends automatically into the stock, you're actually leveraging the power of compounding to increase the ultimate ROI of your portfolio. So it is really a win for you. And this is also very important, especially if you have a long-term vision in the company whose shares you have bought. A lot of people will buy companies for their retirement. They'll buy shares of companies for their retirement account, their 401k, their Roth IRA, and so on and so forth. And so they will just let the shares sit in the portfolio for 20, 30 years. So if you take the power of compounding, even $5 over 30 years is a lot. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kibu. We are also having an interesting conversation around stock investing, and I'm going back to the fundamentals with you. And I've talked about dividends. I've talked about what a stock is. Now let's talk about the advantages of stocks for retirement. Stocks historically have produced long-term gains that are bigger than those of any other assets. Hands down, folks, hands down. So since 1926, we're talking about a century, large stocks have returned an average of 10% per year. What's even better, they did not lose ground during any period of 20 years or longer during that time. So those qualities and other attributes make stocks more appealing for long-term savings than, say, treasury bonds, which have about 5.6% average annual gain since 1926, or stashing cash under your mattress. I'll just quickly talk about stashing cash under your mattress in a minute, but stocks return potential gives them the best chance to beat inflation over long periods. That's why they are an essential part of a good retirement portfolio. And I want to talk about stashing cash under your mattress or leaving cash in a CD, in a certificate of deposit that pays no interest, or a very small interest. You have something called inflation risk. In other words, if your money is not making you more money, you are actually losing money. This is why if you start a job, let's say they've been paying you $2,000 per month, or let's just say they've been paying you 25 grand per year, and you've been sitting in the same company for 5 years and you're still making 25 grand, you're actually losing money, because 25 grand 5 years earlier could give you a purchasing power that will now be lower now because of the fact that prices keep increasing every year. All right. So what are the risks that you have with stocks? Stocks carry a much greater risk of short-term losses than bonds or cash, which are the other two major asset classes. And that makes sense because of the duality between risk and rewards, right? So the higher the risk on a particular asset, the higher the reward. And the reward here is the ROI, the return on investment. So since World War II, Wall Street has endured 6 bear markets, defined as a sustained decline of more than 20% in the value of the S&P 500. So when you hear the terms bear markets, recessions, those are pretty close, conceptually speaking. So when you have that, it is generally not a good idea to invest a big chunk of money in stocks if you will need to spend the money within 5 years or so. And this advice is really appropriate for retirees or folks who are nearing retirement. You don't want to spend, you want to have a split of 70-30. So 70% in fixed income products, including bonds and treasury bonds, corporate bonds and treasury bonds, and 30% in stocks. And you reverse the proportion, the portion rather, if you are in your 20s or 30s and can overcome or can wait for a bear market, or you can actually be patient enough, you can be resilient enough to wait for the storm to pass. Let's now talk about how you can buy a stock. I mean, nobody really buys one share, but how do you buy a share? You buy shares in a company. The most common way is through a broker. So you go through a broker, you fill out some paperwork, you send them your info, and they'll open the account for you. Now, brokers are paid to trade stocks and other securities on behalf of customers. This is different, though, than giving investment advice, though some brokers may also be registered investment advisors. So there are two kinds of brokers. You have one called full service and the other called discount. A full service broker dispenses advice and can even manage your portfolio for a price, of course. For example, a full service broker may charge between 1% and 1.5% of the dollar amount of a stock purchase. So if you were to buy, say, 5,000 worth of stock with a broker fee of 1%, you would have to pay $50 for that transaction. Some full service brokers offer flat fees instead. So that's the definition of a full service broker. Let's now talk about a discount broker. A discount broker may do little more than complete transactions for you. So they are doing this at a more reasonable price. And they're able to do this because they are not fully into the transaction. They're just serving as a middleman, as an intermediary. Some online discount brokers, for instance, offer trades for under $10. So one type of discount broker, known as a share broker, charges a fee per share traded. Share brokers typically charge less per share for larger trades. Think about it. This is like the whole economy here. So you're getting a discount versus you're getting a. So if you're buying wholesale, the more shares you buy through a share broker, the less price you pay per share. For example, sometimes there are strings attached to cheap trades, such as requirements to make a certain number of trades per month or to maintain a minimum balance. That's how they make money. That's how they get you, because no matter what kind of broker you choose, you always want to read fine prints. You want to spend time to know exactly what you're getting yourself into. Okay, I will be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are doing fantastic. You are still enjoying the conversation here. If you do, please consider subscribing to our channel and turn on the notification bell so you can follow us every single day when we drop a new show. And we do this every single day. Like, comment, and share this content. Can you buy stocks via a mutual fund? That's a question we've heard a lot when we were doing research for the show. The answer is yes. And this is often a better idea than buying them individually, in part because you get greater diversification for your dollar. Right? So you're basically trying to, let's say you want to get, you are interested in the technology sector, and instead of buying one stock, say Tesla, you want to buy a mutual fund that invests in that sector. What are the different types of stocks you can buy? There are thousands and thousands of stocks to choose from. So investors usually like to put stocks into different categories. Here I'm talking about sizes, style, and sector. Thinking of stocks this way helps you diversify. That is, you can choose several stocks that are different enough from each other that they won't all tank at the same time. I mean, ideally at least, right? So what you're trying to do, you're trying not to put all your eggs in the same basket. You are putting your eggs in different baskets. So when you analyze stocks by size, what you're really looking at is the company's market capitalization, which is the current share price times the total number of shares outstanding. It's really how much investors think the whole company is worth. Companies are typically referred to as either small cap, mid cap, or large cap. Large cap companies, those with market capitalizations are in the tens of billions of dollars, tend to have more stable stock prices than small caps, so they're less risky. But small caps usually have higher growth potential. You can also classify stocks by style. There are two major styles: growth and value. A growth stock is usually issued by a company that is expanding at an above average rate. So right now, for instance, you can say that Tesla is a growth stock. So you can catch a successful growth stock early on, and the ride can be spectacular, like some investors have done recently with Tesla, this Tesla stock. But the greater the potential, the bigger the risk. Growth stocks raise higher when times are good, but as soon as growth slows, those stocks could tank. A value stock tends to be slower and steadier. But the great part of this is what? You have strong fundamentals. In general, though, if it trades at a lower than average earnings multiple than the overall market. So when you hear people say, I'm a value investor, what they mean is that a value investor is someone who looks at the long term, and looks at fundamentals before making a decision. He or she might think the underlying business is still sound and that its true worth isn't yet reflected in the stock price, even though the stock price is still trading at the lower than average earnings. And then you also have the third category of stocks, sector. So you can categorize stocks by sector. S&P, Standard & Poor's, breaks stocks into 10 sectors and dozens of industries. Generally speaking, different sectors are affected by different things. So at any given time, some are doing well while others are not. Now, the question is, are stocks taxed? And the short answer is yes. So you can put as much money as you can into a tax shelter retirement account, because that's the only way you don't have to pay taxes. So the retirement accounts such as the 401k and IRAs, those are pretty good. And the reason why stocks are taxed is because the investment in those accounts grow tax-free until retirement, at least for the tax sheltered retirement accounts, meaning you will wind up with way more money in your old age than you would have otherwise. When you own stocks outside of tax sheltered retirement accounts such as IRAs and 401ks, there are two ways you might get hit with a tax bill. I think I spoke about this a little earlier. If your stock pays a dividend, those dividends are taxed at a rate of up to 15% at the end of each year for most taxpayers, and that 15% is what's called the capital gains tax. And at 20% for individuals with more than $415,050 in taxable income. And the amount for married couples is $466,950. In addition, if you sell a stock, you pay 15%, which is again 20% for high earners, of any profits you made over the time you held the stock. So if you think about it, so you have dividends, you're paying income on dividends, you're paying income on unrealized gain, capital gain. So that for you to pay taxes, you have to realize the gain. You have to earn the profit. You have to earn the revenue. Otherwise, it remains unrealized, and there is no tax on unrealized capital gain. Now, those profits are known as capital gains, and the tax is called the capital gains tax, as I said earlier. Now, there is one exception. If you hold a stock for less than a year before you sell it, you'll have to pay your regular income tax rate on the gain, a rate that's usually higher than the capital gains tax. All right, let's recap today's conversation. I was talking to you about what a stock is, how you make money on stock, what dividends are, what the advantages of stocks for retirement are, what the stock risks are, and how you buy a stock. I also spoke to you about whether you can buy a stock via a mutual fund, what the different types of stocks are, and whether stocks are taxed. And the answer, of course, is yes. Stocks are taxed. I will see you next time. Thank you for listening. And until then, remember, stay marvelous.